Disclaimer. 3 weeks ago, on a Friday afternoon at 4:55 p.m., the exact time Wall Street buries its bad news, a single document flashed onto the SEC database. Most analysts ignored it, but if you zoom in on the aggregate total, you see the signal they tried to hide. $89 billion in insider sales. That is not a portfolio rebalancing. That is an evacuation. While the mainstream media tells you to buy the dip and hold on for the soft landing, the architects of the system are quietly heading for the exits. They are selling at the fastest pace in history, and they are betting you won't notice until the trap snaps shut. It's not just Bill Gates dumping stock. It's Jeff Bezos. It's Mark Zuckerberg. But here is the smoking gun, Jamie Dimon, the CEO of JP Morgan, the man who held through 2008, the man who hasn't sold a single share in 19 years. He just broke his streak. The question is, what does he see coming that you don't? The question isn't just why he sold, it's how we caught him. To decode that move, we need to look at the specific law that forced his hand. This leads us to the confession booth of Wall Street, the Form 13F. The billionaires and hedge funds don't want you to see their trades. They want to move in the dark. But under the Securities Exchange Act, anyone managing over $100 million in assets has no choice. They are legally required to disclose their holdings to the public. It is the only window we have into the real portfolios of the elite. But before you rush to copy their trades, you need to understand the trap hidden in the fine print. Here is the catch that ruins most retail investors. The data on a 13F filing isn't real-time. It has a 45-day lag. Think of it like looking at a star in the night sky. The light you are seeing right now actually left that star weeks ago. In reality, that star might already be dead. It's the same with these filings. By the time the SEC publishes the document, the smart money has already made their move, secured their exit, and left the building. You are looking at a snapshot of the past. If you try to trade this data day by day, you're just chasing ghosts. So if the data is old, why are we looking at it? Because we aren't looking for a single trade. We are looking for a fire alarm. When one billionaire sells a stock, it's noise. Maybe they are buying a yacht. Maybe they are paying a tax bill. It doesn't matter. But when the entire neighborhood decides to sell at the exact same time, that isn't a coincidence. That is a coordinated evacuation. To spot the crash of 2025, we have to ignore the individual noise and track the aggregate signal. And right now, that signal is screaming red. But while the insiders are rushing for the exits, the public is doing the exact opposite. This creates the most dangerous divergence in the entire financial system, the trap of exit liquidity. If you look at the S&P 500 right now, it looks like a celebration. Retail investors, the dumb money, are pouring cash into the market at record rates, chasing all-time highs and believing the soft landing narrative. But this enthusiasm creates a deadly mechanic. To sell billions of dollars in stock without crashing the price, you need a buyer on the other side. You need liquidity. And right now, retail investors are providing that exit liquidity. They are buying the hype, which allows the smart money to sell the reality. The trap is set. The public is rushing in through the front door, while the landlords are quietly slipping out the back. We don't have to guess about this. The math proves it. We track a specific metric called the insider buy-sell ratio. In a healthy market, you want to see executives buying shares in their own companies. It signals confidence. Right now, that ratio has exploded to 4.7 to 1. For every single insider brave enough to buy their own stock, nearly 5 are dumping it. To put that in perspective, imagine you are in a crowded movie theater. The film is playing, the audience is cheering, but you notice the 5 people who own the building are quietly walking toward the emergency exit. They aren't running, that would cause a panic, but they are leaving. This ratio is the clearest insider selling warning we have seen in years, but the raw numbers only tell half the story. The real terror is in who is leaving. We aren't talking about mid-level managers selling to buy a vacation home. We are talking about the architects. The people leading this exodus are the founders, the very people who built the digital economy. When the creators start betting against their own creations, you need to pay attention. And the first name on our list is the man who put a computer on every desk in the world. But when we crack open his personal file, the story changes completely. Most people assume the architect is still betting on Microsoft, but his private ledger tells a story of relentless liquidation. If you look at the filings for his personal wealth vehicle, Cascade Investment, LLC, you see a very different story. At the company's IPO, Gates owned 45% of the stock. Today, through systematic selling, He has reduced that stake to less than 1.4%. He hasn't just trimmed his position, he has effectively evacuated the building. He has taken the chips off the table and converted them into cash. But the most terrifying part of this file isn't that he sold, it is exactly where he moved that $50 billion. You would expect a tech visionary to double down on the future, maybe reinvesting that cash into AI, microchips, or the next digital revolution. He didn't. He bought trash, literally. One of Cascade's largest holdings is Republic Services, a waste management empire. He bought the Canadian National Railway, heavy logistics, and steel. And most famously, he quietly became the largest private owner of farmland in the United States. Do you see the pattern? Bill Gates is selling the digital economy, which relies on infinite growth, speculation, and hype, and he is parking his wealth in the physical economy. He is buying things that people need to survive, regardless of what the stock market does: food, transportation, garbage removal. He is betting that the future isn't about the next app, it's about basic resources. Here is the verdict on the Gates file. The man who created the software industry is effectively shorting it. He is moving his entire fortune into dirt, steel, and waste. Now look at your own portfolio. If you are like most people, your 401k is weighted 40 or 50% towards tech stocks like Nvidia, Apple, and Microsoft. You are betting on the very thing Bill Gates is selling. You are buying the paper assets he is dumping to buy hard assets. That is a dangerous side of the trade to be on. That brings us to the new pattern emerging in 2024. It isn't just about volume, it's about violence. While the architect rotated slowly, the new wave of insiders are hitting the eject button with a terrifying velocity. It isn't erosion, it is a landslide. When we track the smart money exiting the market right now, the most alarming variable isn't the volume, it is the velocity. Gates took years to unwind his position. The current wave of insiders are doing it in days. They are hitting the sell button with an urgency that suggests they believe the window of opportunity is closing fast. They aren't trying to rebalance a portfolio. They are trying to beat the clock. And nobody illustrates this panic selling speed better than the founder of Amazon. Let us look at the trading logs for Jeff Bezos in February 2024. This was not a gradual sell-off. It was a cash grab. In a span of just 9 trading days, Bezos dumped 50 million shares of Amazon. Total value, $8.5 billion. To put that velocity in perspective, he was liquidating nearly $1 billion of stock every single morning. When a founder sells that aggressively, they aren't looking for liquidity to buy a boat. They're looking for an exit. It screams, "Get me out at any price." But while Bezos provided the speed, our next suspect provided the shock. This is the anomaly. This is the anomaly that should make every investor sit up and sweat. Jamie Dimon, the CEO of JP Morgan. On Wall Street, he is known for having diamond hands. He became CEO in 2006. He held through the 2008 financial crisis. He held through the 2020 pandemic crash. For 19 years, through every disaster, he never sold a single share of his own stock. He was the ultimate believer. But in 2024, that streak ended. He sold $150 million worth of stock. Now, the PR team will tell you it was for tax reasons or estate planning. Don't buy it. You don't break a 19-year streak of loyalty just to pay a bill. Unless you believe the stock price has hit a ceiling it won't see again for a long time. Dimon didn't just sell, he warned us. He is on record saying an economic hurricane is coming. But while the banker is shouting about a storm, our final witness is screaming a warning without saying a word. If Gates is the architect and Dimon is the insider, we must turn our attention to the oracle, Warren Buffett. We just need to look at the balance sheet for Berkshire Hathaway's Q3 2024 report. This is the Warren Buffett cash pile, $325.2 billion. That is not just a rainy day fund, that is a war chest. It is the largest stockpile of uninvested cash in the history of his company. Remember, Buffett's entire philosophy is based on finding value, buying dollar bills for 50 cents. The fact that he is sitting on $1/3 trillion tells you one thing. He cannot find a single stock in the entire market worth buying. He has looked at the global economy, and his verdict is pass. But the cash pile isn't even the scariest part of the report. The real sell signal is hidden in what he didn't do. For years, Buffett has been the biggest buyer of his own stock. When he thinks the market is fairly valued, he buys back Berkshire shares by the billions. It's his vote of confidence. In the last quarter, 0. For the first time since 2018, the buyback machine went completely silent. This is the ultimate red flag. It means Buffett looks at his own company, the business he knows better than anyone on earth, and says, even this is too expensive. He isn't just selling Apple and Bank of America, he is refusing to invest in himself. When the greatest value investor in history stops buying his own stock, it means the price has detached from reality. Let's put these three case files together on the evidence board. Bill Gates is dumping tech to buy dirt and trash, betting on survival. Jamie Dimon broke a 19-year streak to liquidate cash, betting on a hurricane. And Warren Buffett is hoarding a historic war chest, betting on a collapse in value. These men don't operate on feelings. They operate on data. The first chart explains the why, and it is the single metric that keeps the oracle up at night. Officially, it's called market capitalization to GDP, but on Wall Street, they simply call it the Buffett Indicator. Think of GDP as the concrete foundation of a house, the actual value of everything the economy produces. Think of the stock market as the roof. In a sane world, the roof sits directly on the foundation, a ratio of 100%. But look at the history. Before the dot-com crash, the ratio stretched to 140%. Before the 2008 collapse, it hit 105. Today, we are hovering near 200%. The roof is floating miles above the house. This detachment is the mathematical setup for a stock market crash in 2025. We are effectively paying double the price for an economy that hasn't grown. Why does this gap matter? Because of an economic law called mean reversion. Financial gravity is inescapable. The market always returns to the size of the economy eventually. Imagine a rubber band. You can stretch it away from reality for a while, maybe a year, maybe 5. But the further you stretch it, the more violent the snapback will be when it finally breaks. This explains the $300 billion cash pile. Buffett isn't betting against America. He is simply looking at a rubber band stretched to the breaking point and refusing to stand in the path of the recoil. He knows that when the snap happens, prices will fall back to earth, and that is when his cash becomes king. He isn't waiting for a dip. He is waiting to buy the wreckage. But here's the thing about bubbles. They can stay inflated for a long time. Valuation alone doesn't cause a crash. It just loads the gun. To pull the trigger, you need a catalyst. If the Buffett indicator is the bomb, this next chart is the fuse that just ran out. For 50 years, this specific signal has predicted every recession with 100% accuracy. It is called the Sahm Rule, and it is the most accurate recession detector in modern economic history. Look at the track record. In 1970, it flashed red before the stagflation crisis. In 2000, it triggered right before the tech bubble burst. In 2008, it signaled the crash before Lehman Brothers even collapsed. It doesn't rely on market sentiment or expert opinion. It relies on cold, hard labor data. Since 1970, this rule has a perfect batting average. It has never fired a false alarm, not once. When this specific line is crossed, a recession isn't just a possibility. Historically speaking, the signal has never been wrong. Here is the mechanics of the trap. The rule triggers when the 3-month average of the unemployment rate rises just 0.5% from its lowest point in the last year. That sounds like a tiny number, barely a blip. But in an economy, it is the first pebble of an avalanche. Once unemployment starts ticking up by that specific amount, it creates a feedback loop that cannot be stopped. You lose your job, so you stop spending. Because you stop spending, businesses lose revenue. Because they lose revenue, they fire more people. It creates a collapse loop. The absolute number doesn't matter. Unemployment can be low historically, but the momentum is what kills the economy. It signifies that the engine has stalled and is starting to roll backward. And that brings us to the final trigger of 2025. In late 2024, the Sahm Rule officially crossed the 0.5% threshold. The alarm didn't just flicker, it is ringing. Historically speaking, this means the recession hasn't just started. We are already inside it, and the data is just catching up to reality. This is exactly what Gates, Bezos, and Dimon are reacting to. They aren't selling because they dislike their companies. They are selling because they see the avalanche coming down the mountain, and they are getting out of the way before it hits. The roof is detached, and the fuse is lit. So, if the smart money has already built their lifeboats, the only question left is, where are yours? To build that shield, we have to track exactly where they are moving their capital. When the elite flee the stock market, they don't sit in cash that inflation eats alive. They run to hard assets. These are the defensive assets the insiders are buying now. Remember, I am an investigator reading the data, not a financial advisor giving you tips. I show you the evidence. You make the verdict. But let's be clear about the objective here. The goal of this rotation isn't 10x growth. It isn't about getting rich quick. It is about survival. It is about zero loss. It is about owning things that exist in the physical world, things that cannot be diluted, printed, or erased by a central bank policy error. And if you want to know what the ultimate safe haven is, don't listen to what the Federal Reserve says in their press conferences. Watch exactly what they are doing with their own reserves. Look at the data from the World Gold Council. It reveals a massive contradiction. While central banks tell you the currency is strong, they are frantically trading it for metal. In 2022 and 2023, global central banks bought over 1,000 tons of gold per year. That is the highest level of accumulation since 1967. Think about the significance of that date. 1967 was the final countdown before the collapse of the gold standard. The very institutions that control the dollar are dumping it to buy the only asset with zero counterparty risk. They know the debt is unsustainable. They know the paper game is ending. They are building a shield against their own monetary policy. So let's synthesize the survivor's log. The playbook is right in front of us, written by the most powerful investors on earth. Warren Buffett is holding cash, waiting to buy the wreckage at a discount. Bill Gates is holding farmland, owning the physical resources humans need to survive. The central banks are holding gold, insuring themselves against the death of the dollar. They have all moved their chips from the digital economy to the physical economy. Now, look at your own portfolio. Are you 100% invested in the casino, hoping for one last lucky spin? Or have you built a vault? The architects have left the building, and you do not want to be the one holding the bag when the lights finally go out. Now that the evidence board is full, the picture is undeniable. We aren't looking at random noise anymore. We are looking at a coordinated evacuation. Gates selling the future to buy dirt. Dimon breaking a 19-year vow of silence. Buffett sitting on a war chest bigger than most countries' GDP. They didn't exit by accident. They exited by calculation. The Buffett Indicator is the bomb. The Sahm Rule is the fuse. And the smart money has already cleared the blast radius. The recession isn't a possibility you need to debate. It is a mathematical certainty that has already begun. You are either holding the bag or you are holding the shield. Now you have the file. But I want your verdict on the record. Is this a standard economic cycle? Or is it a controlled demolition? Leave your answer in the comments. Cycle or sabotage? Do not face this storm blind. If you want to track the smart money's next move before the mainstream news reports it, subscribe to the investigation. The next file we open tracks the institutions holding your deposits and why they might be the next domino to fall. That analysis starts now.